Hey guys, it is Monday, and on Mondays we talk about Mortgage Move Mondays. Why? Because I am going live in 2025, and you are going to get you a home, get some information to share with someone else so they can get a home. But we are talking all things mortgage moves on Mondays. And it is important because we know we're living history, right? We're living history with having a new president, with the market. We're dealing with every single thing that we're dealing with. We got planes crashing. We have all types of stuff going on. So as a lender, it is my job so that way I can keep you acclimated. So that way you can stop getting advice from your friend and your friend and get advice from a mortgage professional like myself. I am Natasha Robinson, MLS number 332074, and I am live today, and I want to go ahead and get started right away. Of course, we want to give people time to tune in, and this PowerPoint and Zoom will be shared with everyone that has registered. And if you are not on the regular list for every Monday at 6 p.m., definitely you should tune in. Tonight, we are going to talk about getting mortgage ready, guys. And when we're getting mortgage ready, and I just wanted to show my little hoodie, right? Because it says all I want is stocks, real estate, and all of that type of stuff. And real estate is one part of our generational wealth. It's not all of it. It's just one little part, but it is the least expensive part, but one of the most expensive commitments that you'll probably make in your life for 80% of the people listening and the people that are applying for mortgages. So I want to talk to you guys about getting mortgage ready. We've had a lot of high-level conversations, but tonight we're just going to go back to the basics and see if you are really mortgage ready, right? Many myths. I got to have a 720 credit score, right? I got to put 20% down. No, you do not, right? I got to have a 700 credit score. I'm going to say that one again, because I don't know how many people have waited 3 years to get their credit score to a 720. And I just want you to know that in some cases, whether you have a 720 or a 640, your interest rate might be exactly the same, depending on the program. But you know what is not the same 3 years later? The market, right? From the trend that we've seen in the past 5 years, real estate has gone up every single year. So the more time you wait to purchase and own, the more expensive it's going to cost you. And in addition to that, you get 0% interest back on paying rent. So the 3 years you waited, you could have paid your home off 3 years sooner if you would have purchased a lot sooner. And we're not here to rush you. But as a mortgage professional, I'm here to let you know if you're ready, if you're not ready. And one thing that I do very well is just because you don't qualify with me doesn't mean you're not ready. I can refer you to other lenders. So once I see your profile and we talk about it, I can set you on a track so that way you can get to where you're trying to go with the right information. So just want to say thank you guys for tuning in. Congratulations for taking that first step. If you're here today, you've made the commission to get buyer ready. So keep that in mind, and we're going to go ahead and get this rocking and rolling. Understanding your credit score. We just talked about that. Do you want a 720? Absolutely. Do you want a 740? Absolutely. That is where you want to be. So regardless of what lenders say about you qualify with the 540, 10% down, 580, 3.5% down, that is definitely true, right? But let me tell you one thing about that being true. You will not be able to have the bandwidth you need once you get into that property if your score is very low. I will give you an example. At a 580, yes, I can get you a mortgage, right? It may be a little difficult, more difficult underwrite. However, with that 580 credit score, I can actually get you into the property. You can probably put 3.5% down, but now you're a landlord, right? So if you don't have a lot of money saved and the furnaces go out, you have to fix the furnaces for the tenants. You can't really go to Home Depot with a 580 credit score and get credit for a furnace, right? So when you maintain higher credit scores, you have more time to react to a problem, right? So with that situation going on, so if you have to replace your furnaces, if you have a higher credit score, you can get 0% interest. You can get a credit card. You can have more bandwidth. And oftentimes, if you have a higher credit score, you're going to have lower interest rates. That's going to make your payment lower. You're going to have lower insurance premiums. So credit is going to save your life in many situations. Yes, we can get you into a 580 credit score. What are we looking at? We are looking at your revolving credit. If you have credit cards, we're looking at late pays. If you have bankruptcies, if you have foreclosures, if you are over the limit. And I want everyone listening today to understand that there is a big difference between Credit Karma and a mortgage credit score. Credit Karma, I get people all the time. I had an 800 credit score on Credit Karma. Now yours is a 580. Well, I hope you don't have that big of a gap. But the difference between consumer credit and mortgage credit is this. If you go to the mall right now and you apply for 10 credit cards, it is likely that you will very much so get 10 credit cards at 10 different department stores and open them all up and maybe even max those credit cards out. It is not probable that you will apply for 10 mortgages and purchase 10 properties in the same day. So there is a difference between consumer credit and mortgage credit. If you ever paid a bank late, a timeshare late, that's going to make your mortgage credit be lower, right? You know, it doesn't take a lot of work to get approved for a car. You only in a 5-year relationship most of the time with that car, or a 7-year. In a mortgage, it's a 30-year commitment. So they're looking for a little more than what JCPenney would look for in a credit card, or what the car dealership would look for in a 5-year or 7-year car loan. So keep that in mind and understand that the credit score determines the program that you qualify for. If you're working with that 580 or anything below 620, you're going to be a VA, a FH or FHA buyer. USDA, 620 or better. Conventional, 620 or better. But guess what? On conventional, we are looking for everything: your debt to income ratio, your credit score, and your down payment. Absolutely, with a 620, you can get approved conventional, but most likely that's going to be with 20% down, or that is going to be with a special program. So keep in mind, your scenario is your scenario. When we do our loan applications, you're completing a loan application. We want to know where you live, where you work, how much money you earn, and all of those great things. And it is a soft pull. We are not pulling your credit. Credit pools cost money, right? You don't want your credit pool. I don't want to pay for credit if you don't want to buy a house. So the good thing is that they came up with credit soft pull. So that way I can look at your entire scenario and let you know if you're buyer ready. And if you are buyer ready, then we can pull your credit and get the party started. But if you are not, guess what? We can then have a consultation, give you some tricks to get buyer ready, and then we can revisit it at a later time. And I didn't say this in the beginning, and I don't see any questions in the chat. I know we're streaming on a few different platforms using technology this year, but if you guys do have questions, definitely drop them in the chat. And then if you don't have any questions, or you think of questions later, or we didn't respond to you, we'll definitely get those answers to you as well. Managing your debt to income ratio. So the next thing I want to talk about is your debt to income ratio. What is debt to income ratio? It is a big deal for your lender, right? For FHA loan, we can go to 56%, 56%. For conventional, we're pretty much max at 50%. And for VA, it's a little different. There is not really a rule to it. It's just scored through their system. I've been able to go to 64% on a VA loan and it got approved. That doesn't mean it's going to happen for you, but it has in the past. So how I describe debt to income ratio is your income versus your expense, right? So if you make $1,000 a month and you spend $500 on your monthly mortgage payment, the new one that you're going to get, your car note, your student loans, and all of that good stuff, then you would be at 50%. You made $1,000, you're gonna spend $500. Keep in mind, we do not see your car note. I mean, not your car note. We don't see your Catholic tuition. We don't see your college tuition. We don't see if you got a marijuana habit, if you're going to the casino. We don't see any of that. We don't look at your utility bills. We're looking at student loans, car payments, credit cards, timeshares, anything that is reporting a monthly payment, whether it be a boat. But we're looking at everything that is on your debt to income ratio, and then that is how we're calculating it. I can go to 56% on the back end with FHA. Conventional is going to be 50%. So that is how we determine your debt to income ratio. If you are purchasing a multi-unit, I can take 75% of the rent for the units you are not living in. For example, if you are purchasing a 4-unit and the average rents are $1,500 a unit, I now can take your income and add 75% of the income for the other units, and that income will allow me to help increase your debt to income ratio. Sometimes you don't qualify as a 1-unit property, and a 1-unit property is a single family, a condo, right? A manufactured home. Sometimes we go higher in units to give you more buying power. So once again, that's something that we do in a one-on-one strategy. There are some things we can do, such as I have a car note. I have a young lady today. She makes $3,800 a month. She has a $900 car note. It's not her car note. It's her boyfriend's car note. He's made all the payments and she's just a co-signer. So guess what? Now I'm in a position where I may be able to exclude that debt, right? And I don't want to throw you off, but you may have a installment loan. It may be less than 10 payments. So it's always good to have a professional look at your file so that way we can tell you what works, what doesn't work, and how to get you to your next steps. So that is what we're talking about for debt to income ratio. As it relates to saving for your down payment and closing costs, this is a key, guys. You getting your income tax checks, right? Everybody thinking about what Gucci purse they're gonna buy, what are we gonna do? We need new furniture. We got these old cabinets. We want to replace them. We want to make repairs to our landlord's building and we don't even own it. We come up with so many things that we need, right? Because we work hard every day and we deserve to have all of these nice things that we work hard for, right? What we deserve is to be able to retire and not have a mortgage after 30 years. What we deserve is not to work hard every day to just live check to check. That's what we deserve to do, right? So you have to come up with a savings plan. And I tell everybody, pay yourself first. If you work every day and you make $20 an hour, don't you deserve to pay yourself 1 hour a day, right? That's $100 a week, right? So imagine if you actually save $400 a month, you would be saving $4,800 a year just to purchase your own home, to retire, to live to see another day, right? So with that being said, is that you definitely want to have some money. You are going to have to come up with your down payment. You are going to have to come up with your closing costs, which also can be negotiated. And there is some down payment assistance. But I encourage everybody. I watched all of the loan officers talk about, oh, my client didn't need no money at the table. And just because you have money do not mean that we're going to make you spend it. But as a buyer, you want to at least have $1,500 to $3,000 in your bank account, even if you didn't need anything at closing, because I guarantee you, and if no other loan officer tells you this, I guarantee you that as a landlord, you are going to incur some type of expense that you didn't expect. You also are going to gain equity. You're going to be able to write off your depreciation on your taxes, right? Depreciation is your property losing equity according to the IRS, right? The property, they depreciate the property. It doesn't lose equity, but you lived in it for a year. That's actually a positive income source for you on your tax returns. You're going to be able to have to cut the grass, the landscaper, shovel the snow. All of the expenses that you have with your home, you will be able to write off. So hopefully that'll bring you a bigger tax return that you can save. But something will come up. There will be some type of problem that you will have to address. So you always want to save for a rainy day. And I'll also tell you guys that I was one of those individuals and I was living check to check. And as soon as I got enough money to be okay, I was able to request a raise at my job, and I was actually able to increase my income 3 times the amount because my savings, it got me a little fancy, and it gave me the motivation that I needed to know what my net worth was. So once you start saving and once you start getting in control, you will see that things move a lot different when you're able to make different decisions because you're in a different financial situation. So keep that in mind. Don't want to start preaching to you. And then how to apply. So if you're interested in moving forward, these are the documents. Everybody doesn't ask for these documents, but I'm a lender that will actually do a pre-underwritten pre-approval. We are going to look at your income. So if you're self-employed, of course, I need the documents to your left, your tax returns, profit and loss for any unfiled taxes, right? But if you are not self-employed, please do not ever send me any tax returns if you are not self-employed. It is just like going to court. You are only sending me what I am asking you for to get you that pre-approval. So what I will need is just 30 days of pay stubs, 2 if you're every other week, 4 if you're weekly, 24 and 23 W-2s, and 1 month bank statement, okay? Once I get those documents, I'll be able to get you to the finish line. Many of my clients get overtime, they get bonuses, they get commission, or guess what? Sometimes they work 40 hours, sometimes they work 60 hours. If that is you, thank God to COVID, 90% of most employers will use a third-party source to gather the data, right? So if you are that person, then I would have you log in and provide the last pay stub in 23 and 24. So now I don't have to wait on your employer, and I can get that pre-approval issued for you within a couple of hours of you actually completing the application. So if you want a fast pre-approval, you know, that's pretty much the way you get it. And if you're working with a different lender and you don't want to send these documents, understand that if you didn't submit these documents, you don't have a real pre-approval. I call it a pre-approval. Some people call it a pre-qualification. But keep that in mind that if you did not submit documentation and go through an underwrite, we do pull back reports, because once you go under property, under contract, that is not the time to start getting approved. The time to start getting approved is in your pre-approval status. When you go under contract, you want to do home inspection and then earnest money, clear to close. You don't have time to be talking about more documents and more documents because you want to get that good pre-approval. And keep in mind, documents are going to be expired. So we're going to get updated documents, but we shouldn't be finding out things about a foreclosure from 7 years ago and you're already under contract. That's something that my team will make sure that we do our due diligence, so that way we deal with any of those problems before we issue that pre-approval. We don't want you guys having to go back and tell your kids that, hey, I found a dream house and now I don't qualify, because we want this to be a great experience for you. We don't want your home buying experience to be something to make you never buy a home and never motivate anyone to buy a home. And I always tell people, we're not going to be able to live in Inglewood. We're not going to be able to live on the west side of Chicago anymore because there is not a lot of property available. So if you don't own and you don't buy up your own blocks, you may never get a chance to even own in those communities. So definitely keep that in mind. And of course, this is my QR code where you guys can apply. Once again, it is a soft pull. If you want to do a one-on-one, you can give me a call first, so that way we can discuss what you should and should not be doing based off of if you've heard anything different from the call today and you have some more one-on-one type of questions here. Just want to go over, we did this last week, and you can always tune into the old Zooms, but we do have down payment assistance. We have the IDA, which will give you $10,000, $7,500, $6,000, or $45,000, depending on your situation, right? So we have that grant. We won't go deep into the programs today because we've had slides, but I can do a one-on-one for you with that. The mortgage versus a pre-qualification. I have some more grants in here. I think I mismanaged my slides, but we already talked about the mortgage approval versus a pre-qualification. You definitely want to have a pre-approval. You want the person to collect your documents. I know it seems nice that they didn't stress you out and collect your documents. Do you really want them to start asking for documents after it's already your house? Do you really want to fall in love with a property and then they come back and tell you you don't qualify, or you got to send all these documents to see if you qualify, adding extra stress to your process? I'm going to answer for you. And the answer is absolutely not. You definitely do not want to do that. You want to be pre-approved and know what you're working with before you go under contract. What is a renovation loan? The renovation loan is a loan product. We've talked about a lot of products, but I just wanted to give you a little cheat sheet. We do have a different Zoom for renovation loans, and a renovation loan is a loan where I could take the purchase price and add renovation to it, still close in 30 to 37 days if you follow my rules, and we'll have a boot camp on that, and give you the opportunity to move like an investor, to gain equity, to build that property to what you want it to be. If you're a chef, you want a bigger kitchen, whatever it is that you want it to be, that is what we will have the ability to do for you in a renovation loan. And I have that product and program for conventional, for FHA, and for my veterans with 100% financing. I can actually do that for veterans. And I have a new program called One Time Close, where I can actually do new construction, right? I can do a new construction property for you, 1 unit, and you can build that. I'm sorry, 1 to 4 units, and you can build that from the ground. My agent hates when I say build from the ground. She's like, you have no choice but to build it from the ground. But you can build a brand new construction, live in that property, and we can get you financing for that at 5% down. And for all my investors out there whose antennas is going up, yes, you have to really live there for at least 1 year. And yes, it has to make sense. And yes, they're going to do their due diligence to make sure that you're truly going to live there. But if you are truly going to live there, this is a new, amazing program for you guys that you can take advantage of. I want you guys to avoid common mortgage mistakes, right? Common mortgage mistakes is going to buy a car right after you get your pre-approval, co-signing for someone right in the process, losing your job and not telling me. We're going to do a third-party verification at closing. So we might as well know now, because I may be able to help you out of that situation and into something that will work for you, right? Like financial changes. If you were demoted, I got a lot of people that is on furlough right now. They're not making the same amount of money that they made. Your lender is your friend. Don't be scared to tell us what you have going on, right? Like I got a client right now in the middle of a process, and he just purchased a large purchase. His payment is $1,600, right? It's on his bank statements. I can see it. So if the underwriter sees it, she's going to question it, and that can turn into a problem. But once again, just try to share. You don't have to tell me everything, but you do have to tell me if you have any changes that were made to the information that you gave to me from the beginning, so that way I can navigate you properly. And don't just go start uploading documents. Call your loan officer. Let's have a conversation. We're not financial advisors, but we're giving you mortgage advice. We're mortgage advisors, so let us assist you with that particular situation. Here are some do's and don'ts, and this will be emailed to you in the presentation. As you can see, the do's have a very few lines, and there are a long list of don'ts. So you could definitely go over this, but you pretty much want to keep your situation the same. You don't want to go pay off all your debt because you're purchasing a new home. That can actually decrease your credit score. I get that very common. You know, you want to stay current, right? You want to keep with your current pay, your current flow. You don't want to make sudden changes, right? You don't want to go take $100,000 and pay off everything. You don't want to keep transferring your money between accounts, opening a new bank account. If you have to do those things, some people have to buy a car. Some people have to make a transfer, but just talk to your loan officer. It doesn't mean you can't do it. It just means we want to clear you before you do it to prevent a very stressful, tedious, additional paperwork type of process. Home buyer program and grants. I snuck my one program in there with Ida, and now here are the rest of them. We have the CHAC grant. The CHAC grant is allowing you to do 100% financing on a property. They will give 3.5 to 5% on the particular down payment assistance. We can go over that on a one-on-one with you. Chenoa Fund does absolutely the same. We have another program called Equity Aid. Some of these grants have higher interest rates. So once again, I do a one-on-one with you to make sure that it actually makes sense for you before you get through that process. We do have a doctor program, if you know any doctors, and that will be pretty much every doctor except a chiropractor. And I don't think a chiropractor is flagged as a doctor. Sorry, I don't want to misspeak, but the chiropractor is what's not included. The veterinarians are included. But with that being said, we can do 100% financing if you are a doctor and you qualify for this program. So that's pretty big deal. We just pretty much got that program. And of course, if you're a veteran, we are doing 100% on VA loans. Veterans, if you do not have to put money down. And if you are disabled veteran at the right percentage, I can actually not count the taxes against you, and you're not charged with those additional fees. And Guaranteed Rate does not charge you the $1,600 application fee because you're a veteran. So a lot going on with the different programs, and there's no minimum credit score requirement for that particular loan as well. Once again, we want you to understand your credit. We want you to understand how to be buyer ready. And this is a little high level because we want you to understand basic guidelines, right? We talked about debt to income ratio today. That's going to be a new term for you. 56%, right? For FHA. We talked about the credit score today, right? So there's a lot of different guidelines. So just for you as buyers, call your lender. Just because you had a short sale does not mean you can't buy. Just because you had a foreclosure does not mean you cannot buy. Just because you're trying to purchase a property and it has violations, it has mold, it has mildew, it has a permanent injunction, it does not mean you are not able to buy. And the good thing about me, your loan officer, if it's something that I can't do, I will refer you to the right lender. I will put you on track so that way it is something that you can do in the future. Once again, I am your loan officer, Natasha Robinson. Thank you so much for tuning in with me on this Mortgage Monday Moves. We will be here every Monday at 6 p.m. If you are not following me, you can follow me at Loans by Natasha on Instagram, Natasha Robinson on Facebook, and my website is loansbynatasha.com. If you have any topics you want me to discuss, I am here to discuss those topics as well. I am your loan officer, MLS number 332074. Thank you guys so much for tuning in tonight, and we will definitely respond with all your questions, and we look forward to helping you get to your next level. Have a good night.